Howdy, Jacob here. Today we're looking at Williams-Sonoma in the specialty retail industry. 18.4 billion market cap on 17.1 billion enterprise value. I recently got married and noticed that they're one of those crate and barrel type companies that they're huge on wedding checklists of what to get. I'm trying to think of the word, but when you get people stuff for wedding, a lot of them use the Williams-Sonoma database to request for whatever home goods that they desire. Growth was pretty impressive on a consistent basis from 2015 to 2023, but we are seeing a 10% decline year over year in 2024. That might be due to the fact that they did grow very heavy in 2021 and 2022. So maybe it's still just averaging out to that mid single digit range, which wouldn't be surprising. Huge return on invested capital, 30% in the most recent year. Historically, hasn't been lower than 17.4% in the last 10 years. Hefty growth on earnings per share, well above revenue. And we see both gross and operating margin increasing from 10 years ago. All great signs. Balance sheet shows $1.2 billion in cash on hand, zero long-term debt, zero short-term debt, 1.1 in capital leases. So they can write off all of their interest-bearing debt right now if they wanted to. So from a balance sheet perspective, very safe. Hefty production of free cash flow here, where they are producing about 1.6 billion cash from operations, and capital expenditures are relatively similar to 10 years ago. So they're not necessarily reinvesting back into themselves. Again, I've said this multiple times, especially on this high ROIC screener. It does get a little confusing when you hear everyone on the internet say, oh, high return on invested capital is all you need. That's not true. You need companies that reinvest with the historical high rates of return. And so here we're just seeing that the company does repurchase shares and does pay a dividend. So they are giving money back to shareholders, but that means that they're not reinvesting back into themselves, and they're not getting these historical rates of return. And so you don't give them a premium. So I think you can give them a little bit of a premium due to the fact that if they were to find reinvestment opportunities, they could get these returns. But if you look at their last 10 years, we do not see really any form of reinvestment. Capital expenditures are actually down from 10 years ago, a little bit of acquisition. They're not necessarily reinvesting at those rates of return. They're just giving the money back to you, which again can be great, but then it doesn't deserve a premium on the back end. And so keep that in mind when you do your own analysis, because I've had a lot of people just say to me, and I've seen on the internet, like, oh, because it has a high return on invested capital, it deserves a crazy X premium. And that's not true if they're not actually reinvesting at those rates. Maybe I'll do a quick video on it, just in a quick Excel file, do an example. But again, everything company does, and I have done this video, everything a company does is the use of cash. And so you want them to go top to bottom. What's the greatest return they can give me to, max that out, and then the next, and then the next. So if they can max out 50% with a 20% rate of return, do that. And then the remaining 50%, maybe their share could give a 13% return over the next 20 years, buy back some shares. And then at the end of that, maybe, pay down a little debt. But everything a company pays for is your investment. You're investing into them. You want them to do what's best for you. I sometimes go on these long rants, but I have to say that. So let's get to making some assumptions here. On the revenue growth side, I'm going to stick with mid-single digits. Terminal PE, again, like I've said, I think they deserve a little bit of premium due to the fact that they can reinvest at high rates of return. Historically, they have not, and so I'm not giving them a very expansive premium. They've been increasing their margins, so maybe let's do 12 and 14% share change. They've been buying back roughly 300 million. Stock-based compensation is about 100. So that's about 2%. 2% of their share repurchases. And then on the dividend side, 232 million. That payout the last 4 years is really 25-30%. So they can afford that. Let's increase that Historically, they've increased that quite a bit. Maybe let's do 10%. So we're saying by the end of 10 years, they're probably paying roughly 30 to 35% of their money in a dividend. They are paying maybe 40 to 50% through share repurchases, leaving just 15 to 20% of their free cash flow to reinvest back in themselves, make acquisitions. And since they don't have debt, they don't need to pay down debt. But that gets us to a final price that needs to fall 37% before you get the return that I'm looking for here. I mean, again, I think this is a great company, but again, I ran on about this. Return on invested capital deserves a premium only when they actually are reinvesting to get those types of rates of return. So this is actually the final video in our fundamental analysis. We're then going on to generic next, which just has two criteria in our screener: earnings per share growth over the next 5 years, and then a forward P that's profitable. So my thought process here was that there might be some sleeper companies that currently aren't making money or had a poor performing year, but have historically had higher rates of return and higher margins, to where if we think they can get back to that, it could be selling for very cheap now. I'm going to have to, I currently have quite a bit here, about 2,000 companies, but I'm going to have to do a little bit of preliminary analysis because I think some of these companies might just be a little bit poor. So I will do a little bit of review of these companies before going in. I know my fundamental and dividend yield screener, I did no analysis prior. So this was simply just me looking at the company hands-on first. When you were watching me do it, that was the first time seeing a lot of these companies. Of course, I've reviewed some of them before, but some of them I haven't, and it was the first time. When I do my generic review, I'll do some preliminary analysis to make sure I'm not just going over a company that I'm going to say is 99%, needs to fall 99% before a buy because its margins are crap or whatever. But yeah, it's pretty exciting. We finished our fundamental analysis, dividend yield analysis, and we'll go back to them as companies begin to fall, get closer to a buy price, and maybe I'll do further analysis on some, and then obviously deeper dives in the ones that get within 10% of my buy price. So I do hope you have a great rest of your day. Thank you so much.